Hello everyone, and welcome to today's webinar, Live Well, Retire Better. My name is James Batchelor, and I'm a Chartered Financial Planner here at Progeny, based in our Nottingham office. Before we get into the discussion, just a couple of quick housekeeping points. Today's session will run for around 45 minutes to an hour. This is a live webinar, and the recording will be made available after the event. We'll have time for a Q&A today, so please do submit any questions you might have. You should see the Q&A box either at the top or bottom of your screen. Just to note, we won't be able to provide financial advice during the webinar, but we will share general guidance and practical steps to consider. If you have questions relating to your specific circumstances, please reach out to your financial planner. Joining me today is Peter Denmark, Chartered Financial Planner based in our Edinburgh office, and Josie Fries, Chartered Tax Advisor based in our Worthing office. Together, we'll be covering both the planning and tax perspectives of retirement income. Today, we'll be discussing why retirement planning isn't necessarily about finding one perfect number. Instead, it's about understanding the lifestyle you want, turning that into a sustainable income, and creating a plan that can adapt as life, markets, and legislation change. So with that, I'm delighted to introduce Peter Denmark from Progeny Wealth and Josie Fries from Progeny Law and Tax.
Thanks, James. And my name is Peter Denmark. I'm a Chartered Financial Planner, and I've been advising clients for over 13 years with a specialism in retirement planning, if you will. And for me, this is the most rewarding part of the job, helping people take all the assets that they've built up through their careers, come to that point that they want to stop working and help them make that transition. It's just a really enjoyable and satisfying process to go through. So what we're going to talk about today is my favorite subject.
Splendid. Josie.
I am Josie, a Chartered Tax Advisor. I am based from our Worthing office, but I do service clients internationally as well. When I first started my tax career, I was working in a small tax-only firm. Since coming to Progeny and being able to work with wealth advisors as well, I think I've really learned that, how important it is to have a joined-up approach when you're approaching people's, strategic planning with their income and ready for retirement. It makes such a difference being able to look at it from both perspectives. And then hopefully in this webinar today, we're able to highlight that to everyone.
Absolutely. No, well, thank you both and welcome. So to start with, Peter, one of the questions we get asked time and time again is, how much do I need to retire? So how do you go about answering that question?
Yeah, obviously this is the big question that everyone comes with, and it's a really difficult one, which is ultimately unique to every individual. So big part of the job is helping people to answer that for their circumstances. But I think it can be helpful to have a framework to start from, or a sort of guidance on where we're coming from. So there's a huge amount of research out there, but the one that you'll see quoted in the press most often is put together by the Retirement Living Standards, which is put together by Pensions UK. And what they do is they set sort of 3 frameworks for different standards of living, put all the costs associated with those, and then calculate each and update this each year as to what the net income someone might need to achieve that standard of living. Okay. There's a really useful website that talks you through all the research, but just to look at some of the key points in brief. So if we think about a moderate standard of living, the research suggests that involves an annual holiday a year, eating out a couple of times a month, things like that. And what they suggest is that a single person would need £31,700 net income to achieve that, and a couple would need £43,900 a year net income to achieve that standard of living. Taking that a little bit further, what's referred to as a comfortable standard of living, and where that changes is it's allowing for more spontaneity, more travel, more socializing, just more free disposable income to enjoy time with friends and things like that. And what the research suggests is that for a single person, they would need around £43,900 per annum after tax. And for a couple, that's £60,600 per annum after tax. Now, as I say, these are really useful starting points for people to think about. And you know what I mean, I'd encourage people to go and have a look at the research to understand all the different aspects in the background. But it also assumes that people's incomes are linear throughout, their income need is linear throughout their entire lives, which obviously isn't the case. But what I've tried to do here as a point to start from is I've tried to establish, well, if I want that level of income, what do I need to achieve it?
Yes.
So I've taken about the most basic way of achieving that as we can, which is just to use a portfolio or a pension pot to produce that income, and then looked at each of the examples I talked about a moment ago. So using some pretty cautious assumptions, so using a 2.5% inflation rate for the income to increase each year, and assuming that the investments within the pension grow at 4.5% per annum.
Okay.
I've tried to model this to an amount of money that would run out as someone reaches age 100. And in the background, I've allowed for the introduction of their state pensions along the way as well. So if someone was retiring today, age 60, my estimation is that they would need around about an individual would need around £690,000 per annum to achieve that moderate level of income of 31,700 per annum. And for a couple, that would be 920,000 between their two combined pensions.
So it's a sum of money that's required in order to generate that level of income for life, such that they run out of money at a hypothetical age 100.
Absolutely.
Okay.
So, and then if we take that forward to the comfortable level of income, obviously the amount's going to increase. So for an individual, it suggests that they would need £1,090,000 within their portfolio to achieve their pension portfolio, to achieve that 43,900 per annum. And for a couple, £1,360,000 to achieve that £60,000 per annum income. Now, as I say, this is potentially one of the most expensive ways of achieving this, because inevitably when people get to retirement, it's not just a pension pot that we're going to use to structure their income. I mean, people might have ISA portfolios, they might have a rental property that they're getting rental income from. So for us, it's about taking all of these assets and building a strategy using everything we have to draw upon. And obviously, they all have very different tax treatment. So it's about getting that balance right between how we use all the different levels of income. Now, I know Josie's going to look at some much more complicated examples later in the talk, but I thought it might be helpful if Josie just talked us through those asset classes and their tax treatment just now.
Absolutely. Yeah, please.
So as you can see, we've just done a variety of examples here that we see quite frequently with our clients, don't we? And we've got pension, ISA, property, general investments, and investment bonds. So starting with pensions, certain pensions you can take 25% tax-free. There are some caveats to that, which we will, sort of go over later. And the remaining 75% you can, it will be subject to income tax. And when that happens will depend on how you're drawing down on that pension. For ISAs, you have ISAs, they're fully tax-free in terms of the growth and the income. So that's a real benefit to make sure you're utilising your ISA. Properties, providing their rental properties, you've got income tax to consider and capital gains tax to consider. We've got general investments, which do differ to ISAs, and you have income tax on the dividends and the interest within those investments. And capital gains tax on the eventual sales. And then finally, we've got investment bonds where you've got tax deferred withdrawals of up to 5% per annum. And the gains are actually subject to income tax and not capital gains tax.
Okay, so that's a really helpful selection of different investment tools that you can have in the toolbox. And just a quick question there. General investments is I believe, just like the funds that you would have in an ISA, but they're not wrapped in any particular tax privileges, so they're just subject to the taxes that you mentioned.
Yes, exactly that. So they're not in any sort of protected wrapper. There's no sort of tax-free element to that. So they are just taxable. So I think what we, and you'll agree, tend to say is, utilise your ISA where you can and that kind of thing.
Brilliant. Thanks, Josie. So I think when we meet with clients, they're it's always a unique set of financial circumstances we start from. And then the other big picture for people to consider is the fact that everyone's aspirations are unique to their own retirement. So people will want to have they've got different aspirations for travel, hobbies. A key one is the support they want to give to their family, children, and things like that. And equally, I mean, where they want to retire, there might be a change of location in the process and things like that. So for us, it's about fitting all these pieces of the puzzle together. And then the third one, and potentially the most difficult one, is the fact that while we can establish an amount of income and an amount of money that someone might need at the point of retirement quite easily, it's the fact that retirement's a journey, and it's a spending journey that someone's going to go on. So it's trying to build a strategy that, one, tries to look at what might happen in the future, but equally is as adaptable and flexible to allow us to keep changing that as people's lifestyles change. And there's a sort of a view in the world that people's lives slow down in retirement and they might spend less than they are when they're working, and which is potentially not quite an old-fashioned view of the world. Whereas actually there's a lot of research out there that we know that a lot of people like to spend more money when they retire and travel more, but there's a lot of research to support that. And there's a really interesting piece in the Financial Times recently. It looked at a piece of research that mapped people's sort of movements within 5 major cities in the world, used mobile phone data to track that, and then put an age overlay on it. And it showed that whilst we're working or studying, we've got this kind of spatial filter that controls how we interact with friends and socialize and things like that. But as soon as that's taken away in retirement, it suddenly just widens out dramatically, and it shows that those periods shortly after retirement, our 60s, become potentially the most sociable period of our entire lives. And it's about, you want to be able to enjoy that as much as possible. And it's recognizing that socializing, that social activity potentially is going to cost more than the amount you were spending whilst you were still working. So a big part of helping people understand what retirement needs to be and what it looks like is recognizing that we might need to allow for that increased spending at retirement.
I think that's a really good example where you've had people talk about in colloquial terms about the sort of the period at which they stop working to perhaps up to age 80 or 85 are sort of the go-go years where actually they don't have to work for a living anymore. They've got sufficient assets and wealth to be able to support themselves, but actually then the world is their oyster. They can do whatever they please, and so they will go and do that. Maybe in the later years after they become sort of older and they've done a lot of the stuff that they wanted to do, and maybe they're just a bit older anyway, they have what you might call the more the go slow years, where they don't need or feel the need to do as much as they did previously because they've already done it, and so their expenditure is less. So it's not, as we said, necessarily a linear case of spending the same amount of money every year, but in having a plan that's flexible and adaptable to all of that.
Absolutely. And I think the part where we come in as planners and tax planners is, whilst it can be a really exciting time with all these aspirations that we want to achieve in our lives, there can also be a huge amount of anxiety around loss of identity in leaving our professions or our jobs. Equally, worry about money, will it last, and all that kind of thing. And I think where we can come into that process is if we can help people build a robust but flexible, really well thought out financial plan, it can take away that part of the anxiety, which means people can get their heads around the emotional side of it. You know what I mean? You might be worried about leaving colleagues that you've worked with for many years and all that side of it. So it's about, you know what I mean, a well thought out plan gives us the headspace to go and deal with the other things.
It does, and I think that's a really important point, is so much of what we do, although there is a very strongly technical core to what we do, very much of what we do is relational. So we're helping people to achieve their goals and their dreams and supporting them in that. And that's actually a really great privilege to be able to do the underlying technical work, the foundational work that's going to allow them to do what they want to do. It's rather like we're helping to design and run the engine in the car, and the car is what gets them to where they want to be. They don't necessarily understand how the car engine works, but at the same time, the car engine has to work in order for them to do all the good things that they would hope and want to do.
Absolutely. I think, you know what I mean, the way we want to help our clients understand that is to use really well thought out evidence-based solutions. And I think, James, you're going to help us understand one of the key tools we use for that, which is cash flow modeling.
Yes, absolutely. Yes. So cash flow modeling is a tool whereby we can take the income and expenditure and assets and liabilities that a client has, we can plug them into a model, and then we can look at a series of reasonable, sensible assumptions for investment growth, for inflation, and other factors, looking out into the future to say with a higher degree of certainty than simple guesswork how likely and how probable it is that the client's plans will be successful in achieving what they set out to achieve. And that's an evidence-based solution that sits very strongly alongside the evidence-based investing methodology that we try and promote as financial planners and obviously as tax planners. So we've put together a bit of an example about this. Now, this is not financial advice, and it's also a hypothetical example. These are not real people, but it does give you a flavour and a sense of how this might work. So our imaginary clients, Charles and Moira, 58 years old and planning to retire in approximately 7 years. They are considering phased retirement if that is possible for them. They're also unsure if they can afford to do some travelling earlier than retirement, and they're worried about inflation. It's a very, very common theme. They have earned income for both of them at the moment, totalling £85,000 for their household. They're on course for 2 full state pensions, and they also have 1 small final salary pension that's in Moira's name. They're looking to spend £60,000 per annum in retirement, and they have a medium attitude to risk. So, in terms of their current position, this is the available assets that they have. The house that they've got there is at the top of the list of assets there, but they also have cash accounts. Cash, very important from the perspective of a plan to make sure you've got an emergency fund and to provide necessary liquidity. But in terms of their investments, they've got a stocks and shares ISA each, they've got a SIP, a pension fund each, and they also have a joint investment bond. So these are the assets with which we'll be able to work and to construct a model to test the sustainability of their overall plan. There are some relevant considerations here. Inflation is taken into account in the model. This is something that they themselves have said is important, and this is a very, very common theme amongst clients, making sure that their expenditure in the model can increase by at least the rate of CPI inflation at a minimum every year. The growth rates on the investments are deliberately designed to be conservative, with an assumed pre-inflation investment return on their portfolio of 4.5% per annum. Now, that doesn't mean that that's what we expect the underlying investments to deliver, but it means that it's an assumed growth rate in the model. So if we do better than that in real life, it means that we've underpromised and over-delivered, rather than the alternative to do the reverse, which would be disastrous. So really, it's designed to give the clients more comfort as the plan evolves and as time moves on. So what this then looks like is the output you see here. Now, there's quite a lot of detail here, so I think it's worth just going through some of these different elements here briefly. This chart is a cash flow model, and what it's doing is it's charting the client's lives from the current point in time where they are through to a hypothetical age 100. Each bar of the chart, each vertical bar, represents 1 year of time, and different colours within each bar represent different types of assets. So the lilac bar at the bottom is their house, which is just remains flat in absolute and inflation-adjusted terms over time, because you don't spend a bit of your house, it's a single asset and you live in it. But the other colours represent different things. So pink is cash, blue is investments, and green is pension funds. And what this is doing is playing out their retirement, assuming that they spend that £60,000 per annum and they raise their costs every year by inflation, but just do all the things in model form that they've said they're going to do. What you see is that the level of their assets increases gently as they get towards the point when they stop working in 7 years' time, because we've assumed that's what this is. There's no allowance for phased retirement in this, and that they then spend down their assets and their investments grow, offsetting that. What this model demonstrates is that it's highly likely that they're going to reach their hypothetical age 100, spending what they want to spend without running out of money. Actually, this is probably a stronger position than these clients think they're in, but unless you put this to the test, they won't know that. And therefore, cash flow modeling can be a really powerful tool for helping clients to understand what they can do and to see angles that they may not have actually been able to see. Running out of money for these clients is statistically very unlikely.
Absolutely. And James, I think for me, the cash flow modeling that I do with my clients, one of the most powerful things is the fact that we can build this base case scenario, which is, what we think might happen in the most likely circumstance,
Mm.
but then it then allows us to play around with that and build different scenarios to see how different decisions they might take in their lives could change that long-term view. So
Yeah.
in the thought process that someone might want to retire early or phase their retirement, can you show us what that might look like?
Absolutely, yes, indeed. So this approach is very amenable to trying out different scenarios and different approaches, and it allows clients effectively to pull different levers to see what the outcome would be in a sandbox, in a harmless environment, whereby they can then get a feel for what their plans might look like in reality. So this example assumes there is no further earned income at all. And that's a much more stark example than what the clients themselves have suggested. Now, they might want to carry on working perhaps for a few more years because they love their work, or because they have other social reasons why they want to do that. But if they wanted to stop working and purely on a financial basis, they said, right, that's it, I'm done in 2026. The modelling here suggests that they could do that. And again, statistically very unlikely that they'd run out of money before this age 100. And therefore, if they wanted to stop now, if that was their inclination, they absolutely could do. This is only assuming, again, the 4.5% growth rate. And if they do decide to continue working for even one more year, but potentially up to 7 more years, that would only strengthen the position further. So really, phased retirement for them is an absolute possibility. And again, gives them more, it's another string to the bow just to say to them that they could do this if they wanted to. Gives them more options, more choice.
Okay. And I guess, these models we've looked at so far are taking that assumption that their income remains the same throughout retirement. So are you able to show us that, thinking back to the research we talked about earlier, people wanting to front load their spending and all that kind of thing, we can use the models to look at that as well. So
We absolutely can. Yeah, of course we can. Yeah. So what we've looked at here is the probability that someone in retirement might well choose to spend more in the earlier years and then less in the later years, which corresponds to their sort of their probably their state of health and their wishes as time moves on. So the base case is that they spend £60,000 per annum. This model here assumes that they spend £75,000 per annum every year, again rising with inflation, between where they are now and age 85. And then after age 85, that reduces to £45,000 per annum. Once again, that assumes no earned income from 2026 onwards. So if they were to decide to carry on working for a few more years, that position would strengthen further. But what this does show is that they have the capacity to front load their retirement, to spend more money in the years when they're most likely to be able to enjoy it and to do the fun things they want to do whilst health and circumstances permit, and then to spend less later on. That really does link back very effectively to what you were saying, Peter, about the FT article, and how the whole research joins together and provides a really a very structured and very dynamic retirement plan rather than just being a linear amount every year.
Yeah, absolutely. And I think the other key thing here is going through a process of updating this year on year and seeing your movement along the journey and how that changes, and then being able to revisit those decisions and how they might change things as well is really powerful tool to use.
It is, absolutely. I think there are other things. Now, one of the main things that people might be concerned about is market volatility, because we make assumptions about average growth rates for our cash flow. But they are only averages, and as we all know, markets can be strongly positive in a year, they can be flat in a year, or indeed they can deliver negative returns in a year. So bear in mind, this client here is invested in line with a medium attitude to risk. So we would say that was someone who was invested 60% into shares, not 100%. So the model suggests that they could lose around 44% of their liquid assets in 2026 and still get to that hypothetical age 100, having spent their £60,000 per annum rising with inflation without running out of money. Now, it's unusual, I'd say it's highly unusual for someone, it's not impossible, but highly unusual for someone invested 100% in shares to lose 44% of their money in any given year. And for someone in a 60% portfolio, that's incredibly unlikely. But this suggests that the plan is strong enough to, robust enough to support that. So even if they were to lose that amount of money in a particular year, if the market took a tremendous dive, and incidentally that money didn't come back again the next 2 years immediately, so we're talking about a permanent loss here, it still means that they've reached their age 100 without running out of funds. So that is a really good stress test using this technology to be able to determine the robustness of their plan for the future.
Absolutely. And I think, it's a lot of what we do is about reassurance. And I think that particular tool is a really reassuring factor.
Yeah. So once we understand how an income might work, looking at the cash flow, the next big question becomes, well, where should that income actually come from, and how do we keep more of it? And Josie.
Yeah, so I think what I'm going to do is just talk through some allowances and some tax rates, and then we're going to look at another example with Charles and Moira. So looking at tax allowances first, and I think some of these are really commonly known about, some of them less so. And I think we've got an exciting, dare I say, allowance to discuss today and to show in our example. But starting with those that are actually, really commonly known about, you've got the personal allowance and the CGT annual exemption. And I think it's just worth highlighting that these are both use or lose, essentially. You get them each year, but you can't carry them forward. So just making sure that you utilize them each year and draw income accordingly to make good use of them. Sometimes you see people will sell down assets slowly, for example, just to utilize that £3,000 annual exemption each year. And I think it's also worth saying that they seem to love to play with the CGT annual exemption. It was £12,300 a few years ago. It's reduced dramatically, as you can see. So just something to keep an eye on, because we never know which way it's going to go, really. Then you've got the savings allowance and the dividend allowance. Again, these are relatively well known. The dividend allowance is £500 for everyone. The savings allowance does depend on what your level of income is. So if you're a basic rate taxpayer, it's £1,000. If you're a higher rate taxpayer, it's reduced to 500, and it's actually nil if you're an additional rate taxpayer. So I think it's worth bearing in mind when you're doing your planning, to be aware of what your allowances are. So those are the really commonly known ones. But the starting rate.
Yeah, what's this starting rate? What does that mean?
Yeah, and that's the one that I say is a little more exciting, because I think it's not in every person's case that you see it. It's quite a niche point. It's available for people who have less than £5,000 of taxable non-savings income.
Okay.
And I'm saying taxable because after the personal allowance deduction. So it's up to £5,000. If you have £1,000 of taxable pension, for example, you can still have £4,000 of that starting rate. So it's up to the 5,000, but that's all at a 0% tax charge. So if you've got a person with no taxable non-savings income and they have, they're a basic rate taxpayer otherwise, you could have as much as the £5,000 starting rate and a £1,000 saving allowance, and even, the £500 dividend allowance. So all at 0% tax, which I think is pretty astounding.
That's really remarkable, because most people have heard of the personal income tax allowance, and a fair number of people have heard of the personal savings allowance. But what you're saying then is that beyond the 12,570 on the first of those, and let's say the £1,000 on the second, someone could earn several £1,000s worth of savings income interest on their cash and not have to pay any income tax on that.
Yes, exactly. And I think that's why you don't see it very often. A lot of people aren't aware that if they sort of plan to take income from savings, for example, as opposed to other sources, that they might have as much as 0% tax bill, £0 tax bill on £6,000 of income there. So I think it's really exciting, and I will show how that can be played out with Charles and Moira in a little while. But first, I'm just going to move on to some tax rates. So as you can see, I won't go into each line here. You've got the general tax rate and the dividend tax rate. It's really important to be aware that dividends are taxed at a lower tax rate than non-savings and savings income. So just something to factor into people's planning. You've also got the capital gains tax rates, which I think until recent years, you saw a difference in the tax on property versus stocks and shares. They're all aligned now. So you've got 18% at the basic rate and 24% at the higher rate.
Is it worth just briefly highlighting? So what we're saying with capital gains tax is that once someone's used their annual exemption, that any profit they make when they sell an asset, really they have to pay tax on it, and it's going to be either at the basic rate at 18% or the 24% rate for the hire. Is that right?
Yeah, correct. And it's just worth highlighting that that's the profit. So
Profit.
not in proceeds, the gain. So that is something that we'll need working out. But the ultimate profit it's taxable at these rates. And CGT is looked at after income tax. So income tax will use those bands initially. Also probably worth stating, and Peter will be very familiar with this is not Scottish tax rates. Scottish tax rates are different and much more complicated. So yeah, I think if anyone has any questions about Scottish tax rates or anything, it's worth getting in touch. We won't go over all of those today as well. So yeah, now we're going to move on to Charles and Moira. This is just a hypothetical scenario using Charles and Moira's income sources. It's not achievable for everyone, I will say that, but it's something that can be achieved with some careful planning. So this is a tax computation. I'm sure a lot of you will be familiar with this from your own taxes. And what we've got in terms of income sources, we've got a £12,570 pension, which I've just aligned nicely with the personal allowance. You've got interest, let's say, from a bank account of £1,000, and you've got a gain on a life insurance policy.
Is that the bond we spoke about earlier on?
Yes, exactly that. That is the bond. So, and that's £50,000 in this scenario, making this person a higher rate taxpayer. Essentially, the personal allowance is used against the pension income. So what you will see from the income tax calculation section of this tax computation is that £5,500 of this is taxable at 0% because these clients are unlocking that 0% £5,000 starting rate, and then also having that £500 of savings allowance. Because this is an onshore bond, and I say onshore because offshore bonds are treated a little differently, we've got a notional tax, and we've also got top slicing relief, which I won't go into details, but if anyone has any questions, you can reach out to us after.
Absolutely.
But as you can see, this person has £63,570 of income, and they actually ultimately have a £0 tax bill, which I just think is astounding that this is something that can be achieved.
It's quite remarkable because you said a moment ago that with in the base case they're a higher rate taxpayer, but actually with the application of these different reliefs and allowances, the total amount of tax due for this person is zero. Even having accrued a pretty significant amount of actual monetary inflows for the year. And this really comes back very strongly to what we're talking about, living well and retiring better. So someone's worked very hard, they've saved hard, they've invested hard over their lifetime to accumulate their wealth. And then when the time comes for them to take that money back out, what they're doing is trying to extract the maximum amount of value for themselves such that it's not paid away in tax, but it's available to them as private individuals to be able to spend and enjoy their retirement and do the things that they want to do.
Absolutely. I think the key thing for me here is the fact that we talked before about cash flow modeling and sustainability of the assets that you've built up. And the smaller amount of tax that you can pay means the erosive effect on that larger number is less. So it makes that sustainability picture much better. And even that potential picture for, well, I want to spend more in my early years of retirement, that can be done really tax efficiently. Again, it's much more achievable for people.
Yeah, absolutely. I think it's definitely something that highlights that joined up approach between wealth advisors and tax planners, because I think if you're just looking at it from a tax angle or just from a wealth angle, if you don't really do your cash flow modeling, if you don't do an example tax computation, and we can do a tax computation ahead of the event, a wealth planner will reach out to us. We're thinking of doing this. Like, what could the tax implication of that be? And that's where we work together so well in being able to achieve something like this for a client.
I think for the layperson, for an individual, you don't know what you don't know. So what this really does is it allows a series of joined up approaches across different professional disciplines to allow them to really achieve their goals and to exceed them in many cases. It's making the most efficient use of their assets, making sure that the tax planning is as much on point as possible, making sure that they have as much psychological and material comfort in terms of looking forward into the future with their cash flow to see that they're going to be okay, and then reviewing it on a regular basis so they get the continuous touch points and make sure that they get the ongoing reassurance that even as markets move, legislation changes, the world moves on, they still are in a strong position.
Absolutely. I think as well, Josie, you must have loads of examples of people coming to you who think they're using their assets well, or they've got a certain set of tax planning, and just with some very nuanced tweaks here and there, a huge amount of saving for them personally can be made.
Yeah, absolutely. I think there are certainly some things that, like an ISA, everyone sort of knows about, an ISA, but there's definitely certain things that, reliefs are available, wrappers, etc., that people aren't aware of the benefits. So I think being able to highlight that to our clients, it's actually very rewarding seeing, the impact it can have on people sometimes, that you're saving them so much tax that it can make a difference on their plans, on what they can do with their lives, that kind of thing. So it's great.
I think one thing I've noticed is that people are often more cautious than they perhaps should be for completely understandable and fair reasons. They've spent a lot of time, real blood, sweat and tears, accumulating their wealth over their lifetimes. And actually what they want to do is preserve that as much as possible. And that absolutely is a fair and right objective. But at the same time, they're always accumulating for a purpose. That purpose is so that they can enjoy it when they don't, they're not working anymore. There's no point accumulating wealth for its own sake. It has to be there to serve. And how it serves is, defined by the methodology that you're using to slice and to apply that income and that wealth to their lifestyle as they move into retirement. I think I've mentioned these matters are highly relational. The people are always looking for the right technical solution, but they also want to have guidance and comfort and reassurance that what they're doing is going to be. So it points back to a very simple question: am I going to be okay? And if you can answer that, comprehensively and with an evidence basis to say, yes, you will be okay, here's why you're going to be okay, and we can go into detail about how that will change over time, that's tremendously comforting for a client, isn't it?
Yeah, absolutely. Absolutely. That's the name of the game at the end of the day.
Mm.
Yeah.
So really, this is there's so much that we've covered here today. Just really, what are the key takeaways for when we're looking at this? What one of the key features here we've looked at: pension landscapes. Pensions have had a tremendous amount of change over the last 20 years. We had pension simplification, 2006. We had the now famous pensions flexibilities introduced by George Osborne in 2015. And then more recently, we've got the introduction of pension funds into inheritance tax with effect from April 2027. And that was introduced in the October 2024 budget. Pensions are tremendously powerful tools, fantastic tax benefits, but also fairly technical, built upon a series of interlocking past government's policy decisions, and fairly complicated in their own way. So what does the landscape look like?
Yeah, I think, we've talked about lots of different asset classes today, but, the biggest tool in people's retirement is often the pension. And for me right now, we've got the most flexible set of rules we've ever had. We've got really low cost access to contracts that give us huge range of investments to choose from, but also a huge flexibility when it comes to how we draw the money out and fit it in with all the other tax planning that we've got. So right now it's about as useful a tool as it can be within that wider planning. But as you mentioned, it changes regularly. So I'm just going to run through some of the key numbers that we've got today. So a big one is that we've seen an increase in how much someone can pay into their pension each year, which is great in terms of getting that pot as big as it can be. And we've also have a situation where we can pay £60,000 up to £60,000 a year in, but also potentially use any unused allowances from 3 years. So a pretty big tool we can use
to get more allowances,
and take advantage of all the tax relief that goes with that. We do have to be careful though, because higher earners have those allowances tapered down, so it can come back down to £10,000 if you earn over a certain amount of money. So it's about understanding our clients' needs and making sure we don't lose allowances along the way.
And planning, I guess, is even more vital in that scenario, isn't it? Just to make sure that they're not overstepping boundaries and incurring tax that they don't need to pay.
Absolutely. And another nuance to that, we've got a relevant earnings cap in terms of how much somebody can pay and who's not earning, for example. But also we've got a thing called the money purchase annual allowance, where if somebody takes a bit of their flexible benefits, suddenly that annual allowance comes down to 10,000 as well. So got to be careful about avoiding a mistake there if someone's still earning.
Absolutely.
But a big one is that we had this thing called the lifetime allowance that put this cap on the amount you could have in your pension before you incurred additional tax and things. That was, widely reported that it was abolished, which is great news. But we still, and that gives us more flexibility again, but we still have this cap on how much we can draw tax-free of 268,000, which is based on that old lifetime allowance. So we know that these things are going to change over time. We know that at some periods of time they'll be more lenient, at periods of time they'll be more stringent. But so it's about understanding the environment you're operating in right now and making sure you're not missing out on any of the opportunities that it presents yourself with. I don't think we're going to see much change to the structure of how we can access the money, but the limits that we have to play with will change over time.
And I think this comes into its own with where the planning aspect is really important. Lump sum allowance, so the amount of money that people can take during their lifetimes tax-free from a pension, and everything else is then taxable or subject to income tax. Lump sum death benefit allowance takes into account the lump sum allowance, but also makes reference to the amount of money that can be paid out as a lump sum when someone dies. But the classic example of this is where a beneficiary, can take a pension of an unlimited size in principle, and they draw it as an ongoing income. It's not subject to the lump sum death benefit allowance. So in other words, it's important. It's incredibly important at the point when someone has their estate wrapped up to actually get the right kind of advice to make sure that their benefits are transferred to the next generation in the correct way, so that they don't fall foul of a tax trap that is entirely avoidable.
Absolutely. And yeah, it's maybe not a retirement subject, but making sure your death benefit nomination, for example, is as it should be and kept up to date.
Absolutely, yes. Okay, so really just looking at the whole totality of what we've looked at today, there's a huge amount of great value and great discussion in what we've talked about. So really, what for each of you are the key takeaways from today?
I mean, if we're thinking about somebody who's coming up to retirement themselves, starting to think about all these questions, it's about the first step really is deciding, what do you want your retirement to look like? You know what I mean? What are your aspirations for retirement? Are there any lump sum expenditures that are going to come along the way? How much income do you think you're going to need, and all that kind of thing? And then the second part of that is making sure that all your assets are in the right place. You know what I mean? You've got the right structure so they can be used as tax efficiently as possible. And then it's about the sort of the preparation up to the point of retirement. Am I using as much pension allowance as I can? Am I using as much ISA allowance as I can, and things like that? And keeping that plan under review, doing the cash flow modeling with your advisor, stress testing things, and just making sure that you've got that sort of disciplined approach over the period up to retirement to make sure your plans are well thought out and as robust as they can be.
Absolutely. Josie?
So I think probably a bit of an expansion on what Peter said. I just think planning and knowledge is power in this situation, isn't it? I think whether, you have that knowledge yourself or you're enlisting the help of a wealth planner or a tax advisor, having that knowledge behind you, having a good strategy, having a good, sort of a group of people around you to support you, that support network is just so key in the whole planning process, whether you're 10 years from retirement or in retirement, it doesn't matter. It's important the whole way through. So I think just making sure that you're aware of your allowances, and as you alluded to earlier with the pension contribution allowance, if you exceed that, there are tax charges. So and it's unnecessary. When you could, if you have that knowledge, you could avoid that happening. So just staying abreast of legislation or having those people on your side, us, as advisors, to support you, to make sure that you are setting yourself up for the very best you can, and that's what I think would be the key takeaway.
Yeah, it's about making sure you're making all the right decisions. Equally, there are mistakes that can be made, missing out an allowance or incurring some tax that you really didn't need to, that kind of thing. So yeah, just about making sure you're giving it plenty of thought and working with the professional advisors around you that you've got to make sure it's as smooth and well thought out as it can be.
Well, it sounds very much like a process rather than an event.
Yeah.
And the sort of thing that you can't do in one go. You have to revisit it, but at the same time, that means that you can keep coming back to it and keep adapting and flexing as the situation changes.
Yeah.
No. Thank you, Peter and Josie. It's been a great session. We've covered a lot of ground, but if there's one message we'd like you to take away from today, it's that retirement planning isn't a one-off decision. It's an ongoing process, evolving as your circumstances, priorities, and the wider legislative landscape change. We'll now move into the Q&A, where we'll answer as many of your questions as we can. Okay, got a few questions coming in. I've recently realised that there are some gaps in my national insurance record. How big of an issue is that, and what are the best steps I can take now to make sure it doesn't affect my state pension? Peter and Josie.
I'll take this one to start with. You might have more detail on it than me, but I think the easy answer is that it's really easy to find out where you are with your state pension, just by going online to the government gateway, plugging in check my state pension, and you get a really easy to understand summary. I mean, if you've missed some years or you're not going to make the full allowance, you can quite easily pay some extra and gather up those missed years.
Yeah, I think I'd just add to that, more specifically, you've got Class 3 voluntary, national insurance contributions. Obviously, if you're self-employed, et cetera, you have Class 2 that have always been relevant. You can make voluntary contributions there. As Peter said, it's really easy to check for gaps. You don't even have to call HMRC anymore, which we all know is quite a
A
long
challenging experience.
process. Yes, so being able to do that online, it's so quick and easy that I think it's worth checking as well, and plugging in those gaps, because as we saw from the example, state pension, it does matter, and it is useful. It's a stable thing that you can keep using throughout your retirement.
I think I'm right in saying somebody needs 35 full years of national insurance contributions to get the full state pension. And if there are gaps, they can go back up to 6 years from the present, I believe.
Yes, that is correct.
Yeah, that's splendid, Bob. Thank you. So another question here. With all the talk about changes to the state pension age, I'm not entirely sure what that actually means for me personally. How should I factor that into my retirement planning? That's an excellent question, isn't it?
Yeah, absolutely. Again, we're in this phase process of seeing the state pension age increase. But again, looking online, checking your state pension entitlement gives you the date that it will start. So that helps you build into the planning. And for me, one of the biggest things I see when helping people construct a plan like we've looked at is they often underestimate how valuable that state pension is. You know what I mean? A guaranteed income of over £12,000 a year that's inflation proofed and is guaranteed by our government for the rest of our lives is a very, very valuable piece of the planning.
And I think it gives people a sense of a real central pillar of support for their retirement planning. But I think it's also the other thing it does is it highlights for me is the need to make sure that people don't focus on it too much. So if there's a risk of the state pension age going up in the future, or people are concerned about how where the state pension age is, you don't have to peg your retirement to the state pension age. Your retirement happens whenever your plan means that you can stop working and take your investments, your wealth supports you instead of your earned income at that point. So really, although the state pension will pay whenever it will pay, and that's the purview of government, a good financial plan can mean that you can make assets available and ready so that you can retire when you want to retire, and actually you can bridge the gap between when you stop working and when the state pension starts to pay out. With enough time and planning, that's absolutely achievable, and that is, for me, is a real purpose of what we're doing as well here.
Yeah, it's effectively it's one of the tools in the toolbox that we've got to build that overall plan for somebody.
Absolutely, yeah. Okay, another question here. I'm selling my business this year. Can I use the proceeds to top up my pension contributions for the last 3 years? Good question.
Okay. Well, I guess it's how the business sale goes through, isn't it? And how that's structured, because if it's a capital sum, it's not earned income, so it can't be used for pension contributions.
It's a nuanced question. It's a sort of question where really key advice is important. The simple answer is that pension contributions are limited by the amount of your relevant earnings. And that means that the maximum amount you can put into pension in each year is either the annual allowance, the £60,000, or it's the amount of money that you've actually earned in that year, unless you're getting an employer contribution, and in which case you're subject to the rules on carry forward looking back over the last 3 years. So there is no dead simple answer to this question. I would say this is a classic example of where it's important to sit down and have that detailed conversation with your financial planner to determine the answer. There will be an answer, and the answer might be yes, but it depends on the specifics of this particular situation, I think is the answer there.
Yeah, absolutely.
Can a SIP invest in futures, i.e. derivatives? Wow, that's an interesting question.
SIPs can invest in most things. And in some structures that, you know, you might be able to access futures and derivatives depending on the structure of the investments you're using. But often as well, you're limited to what the actual pension provider will allow you to do within the HMRC rules around that. So whilst the answer is yes, you might need to look for a more bespoke, flexible pension provider to give you access to that type of investment.
I would say on that is an exceedingly high risk investment, and that it would be something that you would certainly want to have a conversation with your planner about. It's not something that normally falls within the scope of retail investing, but there are technical points there that we could explore with a client if they were minded to want to ask those sort of questions. Another one here. So I'm thinking of retiring abroad. What tax considerations need to be on my radar? Josie?
That is a very good question, actually. And it's something that comes up frequently with our clients, especially when I think some countries have tax systems that are, very appealing to people in their retirement. I think the first thing to consider is understanding your UK tax obligations. I see so often that people think just because they've left the UK, that's it. I've left the UK tax system. I don't need to do anything else. They might, consider the residence rules and the point from which they've left the UK. But sometimes people get confused that once they are non-UK resident, they're fine, that kind of thing. So definitely first looking into when you become a non-UK resident, but what are your obligations thereafter? It's such a complex area. I'll do a few details now, but I could probably talk for an entire webinar about this. First, there's double taxation treaties between the UK and other countries. Not every country, but there are many, and they all they're all slightly different. There's no blanket approach, and checking what it looks like for your income sources within those treaties. Generally, you see someone's non-UK resident, they're not taxable on their overseas income. They're not taxable on their capital gains, even of UK assets, bar property and some assets used in trade. But with their UK source income, whilst there's automatic UK taxation on UK source income, there are provisions within the treaties that might state your UK pension might not be taxable in the UK. The taxation rights might be within the country of your residence. Further complicating that is the country you're residing in will have their own special rules. So I think it's so important to have a tax advisor in the UK, a tax advisor overseas, and making sure that you're liaising with both to make sure that you have your taxes sorted in both of those countries. Perhaps looking at pensions specifically, you've got some countries might have a lock on your state pension, so that won't be increasing year on year. ISAs not being able to contribute. There's so many points. We could be here all day. I think those are a couple of the key thoughts that I'd have.
So looking at it from the other side, what should expats consider when planning to retire to the UK?
Well, that is a great question, isn't it? Similarly, starting off with residence rules, understanding when you become UK resident. There's a lot of planning that can be done while you're non-UK resident. So if you have a UK rental property, for example, there are beneficial rules for people that are non-UK residents. So whilst in the UK you have a UK rental property, you haven't lived in it as your main residence, you sell it, you might have a large gain on that because you haven't lived there. There's no relief. You're looking at what you sell it for or less the cost.
Capital gains tax.
Capital gains tax, exactly. But when you're a non-UK resident, it's much more complicated, and there are 3 calculations that can be done with you being able to pick the calculation that produces the smallest gain. So, these sorts of tax planning opportunities, selling your investments whilst overseas, if that works for your strategy, speaking with a financial planner before you come back and seeing, what investments you want to hold. Is it beneficial to rebase? So many questions that need discussing. But because you have that ability to have no tax on your offshore income and no tax for capital gains on investments, you really have that opportunity, that window before you become UK resident to make sure that you are putting yourself in a good tax position, but also having investments overseas, the strategies used overseas aren't actually always the best for when you're in the UK. So I think that's the financial planning side, of course, not the tax side, but we'd work out together what the tax position would look like and what would be best for someone moving forwards.
So it's engineering a solution that's bespoke to the individual in their particular circumstances.
Yes, exactly that. And again, for each individual, it's completely different. There's no one size fits all, I think, in this industry.
That's really highlighting the sort of value of advice.
Yeah, absolutely. Absolutely.
Thank you, everyone, for the great questions, and thank you from myself, Peter and Josie, for joining us today. As a reminder, the recording will be shared shortly, along with a feedback form. If anything we've discussed has raised further questions, please do speak with your financial planner or get in touch with us. Enjoy the rest of your day.